This is the Note Closer Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, excited to be here with you today. Even more jacked up to have our regular credit messiah God, Jesus of Latter Credit Day Saints. Our buddy Merrill Chandler from GetFundable.com and the Get Fundable podcast join us today on the Note Closer Show. What is going on, Merrill?
First of all, so much. I've been a geek for like the last 2 months. I've been geeking out on, of all things, lender policies. So I know that's a thrill for all of you guys. You're like, oh, that sounds like a great way to spend a day. But for me, fundability, think of fundability as the engine, right? The fundability is the ability to get funding. But we're in a massive pivot. Now, I'm going to be sharing some stuff with you today, but we're in a massive financial institution pivot and there's good things going on and there's not so good things going on, but it's a hard pivot. And so I'm studying so that I know how to apply these fundability issues to my clients, to my students, to even to folks who are just on the Get Fundable Facebook page that are just part of our group, or what I call my tribe. There are things people need to know that nobody's talking about, and the lenders once again are pivoting behind our backs. But some of it's good, but not all of it, and they're pivoting on how banks need to show up in order to increase what they call wallet share, right? And so if all the banks are competing for the same amount of your disposable income to pay for credit payments, then and some of it's cool, some of it's just naughty, and so that's what I've been studying for the last 2 months, and it's been really a fascinating thing. Even there's like this big push to take on Gen Z and millennials and get them into banking, and it's kind of I don't want to call it sketchy. It's kind of as manipulative as it was back in 10, 15 years ago when they were driving all those free credit card offers to college students and say, hey, it's free, come and get it. We apply, and people don't even know what is, they don't even know what debt is or debt management or things like that. So now they're like, all right, so we've got, I think it's called Karina's Law. There was a girl who didn't know anything about debt. She committed suicide because she had literally, but it was only like $6,000 in debt. She was 18 years old, was depressed out of her mind, didn't know what to do, didn't know what it meant, didn't know. And that seems nonsensical to most of us, but some people have no education whatsoever on what all this stuff means. And she took her own life because she was so embarrassed. I talk about credit shaming. This girl was so embarrassed that to even talk to her parents about all of this debt that she took her own life. Congress, and then a brouhaha started up, and Congress implemented a statute named after her where nobody under 21 can get a credit card, a credit instrument, without parental or guardian support, right? Well, now they're sitting here and goes, there's an article on here that how can millennials and Gen Z power growth and for financial institutions, right? And their whole thing is young customers. How do we get in front of them? And it's just taking a whole new level of without the right framework, that we are intentional borrowers, right? That we are focused in our borrowing, and we're strategic borrowers, but nobody even has this education. So I've been on the war path to find out what lenders are doing, so we can optimize and take the gifts they're giving, the pay down schedules, the moratoriums, the things that they're willing to do to support borrowers this time versus 2008, like we talked in our last episode. But what kind of shenanigans might some of them be looking at as well? So that's what I've been doing. What about you? That was a long
I have to comment on it because I was going through college 20 years ago, and I can remember the fold-up tables, and it was one of the biggest fundraising platforms for student organizations because you got paid $1 an application somebody filled out. Yep. So they
guaranteed approvals. I mean, just straight guaranteed approvals.
Yeah. Plus the fact that they gave away all those T-shirts and water bottles. And that was the important thing. You wanted to have that gut polished T-shirt, you know what I mean? Animal House. But yeah, they outlawed that in the universities, outlawed that and stuff like that. And it was a great law to outlaw. Yeah. Because it was just really kind of predatory lending. Oh, get the T-shirt, fill this out, whoopie-doo.
Yeah, and nobody knew the inquiries 20 years ago. People that had little to no credit scores weren't out publicly yet. They were still, behind the scenes with lenders' eyes only. So remember the days when they would say, you're at the auto dealer, say, hey, can I see my credit score? And they say, it's illegal.
Yep.
Right?
It's my score. Why is it illegal if you just pulled it there for you? And you're charging me $25 credit pooling fee. I remember being a mortgage broker, and we were supposed to show that. And that was one of the big things, not just at the auto dealers, but also mortgage brokers a lot.
Yeah, because the whole point was that how do we get people to pay for their own credit reports if our merchants are giving them out for free, right? Mm-hmm. So anyway, so that's what education.
Now, thing I want to bring up with you, because I know we talked a little bit beforehand, is that there's a lot of different things going on with the lenders. And there's a lot of stuff that's coming back and biting the lenders in the butt right now. Like one of the biggest things that we've seen, obviously, with the default rates climbing to 8.22% across the country.
Yeah.
The biggest contributing factor to that default rate is your government FHA loans. They skyrocketed from 9.69% default rate in June. July's numbers came out. That number went up 60% to the mid 15%,
right?
Just under 16%.
But it's FHA versus Fannie Freddie this time. Yeah.
And the biggest contributor to that, I will say this because I had a mortgage banker that I was talking to at the evil empire, the B of A.
Right.
Bank of America for the last 12 months has been basically donating the 3.5% down payment and paying $10,000 towards closing costs. So people were basically getting in. It's not free. Really a subprime loan, but it's kind of a subprime.
Well, if you're wrapping in the money for the closing costs, so you're actually it's a higher amount for the loan. Yeah, so what do you think? I have ideas, but why is FHA leading the charge compared to Fannie and Freddie?
Because here's the thing, when you have people, and this wasn't just a Bank of America, I give them a hard case because they're the biggest, they're like the bell cow when it comes to your regular day in, day out residential mortgage borrowers and people getting checking accounts, the biggest, over 5,500 branches across the country. They're the biggest one. So here's the reason why FHA is leading is because if you're getting, as a borrower, and this comes back with all the debt gain from 10 years ago, what's going on? If you can't qualify, if you don't have the 5% to put down, like your conventional mortgage companies were requiring you to 5 or 10% down, you're basically scratching together cash to get into a closing. Okay.
Right.
If you don't have to pay the closing costs and you don't have the down payment, you don't have any investment. You don't have any skin in the game to pay on time. Like, it's a government
loan.
No
buffer.
Exactly. No buffer. Exactly. No buffer for sure. And a lot of times, as we've seen over the last 2 months, as we've targeted these 40 cities, is that $200,000 and below value in just about every city across the country is where the high number of foreclosures is taking place. Now, a couple of exceptions, Miami Beach $1 million condos was leading the way there.
Right.
There's nothing under $100,000 there.
Tuesday, they were way ahead of FHA-backed loans.
Exactly. But it's what it is that's your first-time home buyer. They're the ones that are working in the bars. They're the ones working in the restaurants. They're in the service industry. They're your $25 an employee hour, $20 an hour employee that have been laid off are hurt the hardest for the most part.
Right.
So that's why that's my belief on why that's leading the charge of the default rate.
I went to the same place. My biggest thing, and I've been sharing this in my Get Fundable Facebook group, etc., is that the number one reason is there is no elbow room in these lower. You use the perfect language. They're scraping together whatever it takes to, or they're not having to scrape anything. The closing costs and the down, everything's being comped by the loan. And so now all of a sudden they have the illusion that they're going to be able to all systems go, right? It's going to stay green lights. Nobody pretends that we're going to have a W or a wave. COVID's going to be a wave for a year and a half. And there's no room. And it is the first-time home buyers. It's the ones who are trying to get up and out of their rental environment. And rents are, of course, by and large, more expensive than the mortgages are. And so they're trying to do right by themselves, but don't have any room to do it. Whereas, like you say, Fannie Freddie, that's where I went. Fannie Freddie, at least you have to have savings, right? You have to have some sort of a cushion, both probably in the amount you're putting down as well as the amount on a monthly basis. So because we only choose FHA if we're trying to for the first time home buyers, et cetera. So, and it's dangerous, and it's so seductive because right now we have these refi rates, right? Even the purchase rates are near all-time lows, and we're approaching near zero more and more. And how do you stop somebody who is not actually prepared for home ownership, what it means to do home ownership, because they don't know about homes? Their utilities might be included, the landscaping, whatever it is that they're doing, they're now personally responsible for PI and TI, and they don't put all of that in play, or they don't think about it.
Let's bring it back to something on that, especially the taxes and insurance. Insurance across the board is fine, but what you have seen blossoming up all across the country, those new build communities, buy in $500 down, and the taxes, especially as we saw happening just as the COVID hit. What happened when you have a house that was a lot a year ago, that's now a lot first property on here, your tax values go through the roof, and that's where you have a lot of defaults also on that first time home buyer, because we can budget. We look at the numbers and budget it. What we're at now,
not for the appreciation of the property.
Exactly. Not for the appreciation or the tax increase, which screws up a lot of escrow accounts. And then that's why you see a lot of March, April defaults across the country. And then you have COVID.
Actually, that's great observation. That's a great observation, because that tax reevaluation, remember, assessors aren't going to do their annual one. If the appreciation rate is like this, they're going to come back in 6 months or quarterly and add a new assessment, all right, because they want to capitalize their cities. And now the person who says I can afford $1,300 a month PITI, and now insurance of PITI is, I always say pity the fool who has to make pity the fool who has to pay the mortgage rate. But yeah, now they're just getting obliterated. So that was and also I wanted to address that. I call it the taxation without representation when the Federal Housing Financial Agency Authority comes in and says, you know what, these are amazing rates. You know what? Our countrymen do not deserve these level of rates. Let's put in an artificial tax of 0.5% so that we can capitalize, so that the federal government doesn't have to bail out Fannie, Freddie, FHA. They already had $22 billion in capital reserves, right? But they come in and say, you know what? Let's just, it's not going to harm anybody to pay 3.25 instead of 2.75. So let's just put a tax on all refis. Now, just to let all of our listeners know, they pulled that back because I'm going to take personal ownership of this. I held a podcast, and the next day they lifted that tax. So I must have been insanely influential, unbeknownst to me. But all kidding aside, they lifted that and said they're at least 60 days before they put that out. I think December 1st, maybe, so 90 days. They're holding it off. Which my poor friends who are mortgage brokers now, that some people said, well, I'm not saving much. I got a good deal last time with the 0.5% premium. It's not going to help me much. As soon as they pulled that back off, my people are just flooded. They are up to their desks have 70 files high of people refinancing and trying to lock in these rates. So you're welcome, you guys. I just want to tell everybody you're welcome for getting another 90 days cut off of that. My personal influence was an important contribution there.
Let's talk about this though, because things just happen. Obviously, in most of the country, Fannie and Freddie, they extended the forbearance agreements as we knew they were, as we talked about this on a couple episodes ago, correct? They did the forbearance agreement out for another 5-6 months because most of the state moratoriums ended yesterday, August 31st being the end date for foreclosures or evictions to start back up again. Minnesota delayed theirs until September 11th. On Patriots Day.
Nice.
Yeah. But that, there's so much, people are so scared and evictions are increasing. I mean, they're expecting a lot of people.
Well, there's been a lot of back pressure to that because anything that's artificial, that's put in artificially, we've got landlords are saying, I have people who can pay, but you're taking up my home. The folks are scared to death because they thought they would be employed after 6 months of COVID, or they'd come back. They're not yet, and they don't want to be out on the streets, right? So we've got there's this huge conflict, and then you've got the good guy, bad guy that every landlord is, right? All of us have that good guy, bad guy, and they're sitting here going, I've been compassionate. I want to take care of you. I want to do my best, and I'm not using my moratorium because my fundability coach told me not to. So I'm not using my moratorium. I got to pay my bills. And so literally the shit is just rolling downstream, right? And everybody is taking a hit in some way or another. This is crazy. And home prices in 30 markets are just skyrocketing. The hell.
Realtors are out there. You want to buy a home. And it's like the world is burning, but it's a great time to buy a house.
Yeah, they're playing their fiddles while Nero plays his fiddle while Rome burns, right?
Exactly. Here's the thing I wanted to bring up too with you. When you look at, we talked earlier on back in February. I did an episode called the CMBS meltdown, $50 billion lost. They're expecting banks. In 2 weeks, January 17th, they came out with an article as the banks filed their second quarter reports about what they're looking at. And then you look at the big four banks, they've got over $150 billion at mid-year forbearance agreements across the board, almost a record deferred of $32 billion for loan losses. Okay. And the banks, here's the thing, the big kicker here, it's your local banks have financed, especially on the commercial side, have financed 54% of the bad debt hitting their books, that small balance commercial stuff. So banks are looking to lend to offset those losses. Okay.
Yeah.
It's I won't say it's a perfect storm. I would say it's a perfect apocalypse.
No, if you're going to have apocalypse, let them try and offset losses by giving small business loans. Our market under $1 million is like they're doing it for their saving grace. You're actually talking about some of these things. They're saying the perfect time is the pivot right now is small business and personal, and for some reason they are just celebrating sole proprietors, because sole proprietors are it's an alter ego, right? So they get to give a business loan to an individual rather than good thing that we build our whole QFE, right? The qualified fundable entity is a transparent fundable entity. So we qualify, it's spectacular, but lenders haven't trained it. We've trained our borrowers how to be fundable, but banks are going sole proprietors because it's a personal personal guarantee that isn't even transparent. It's to the person, but they get to put it on their business books, right? And so this saving grace that they're looking for, it's like priming the pump, but using a different pump to prime this one. I don't know. They're just generating cash. All I know all I know is in the last quarter, this quarter so far, my clients are at $5.3 million in fundings over the previous quarter of $4 million. Pre-COVID, we averaged around 2.5 million per quarter. We are at 5.3 in 2 months of the third quarter, because they are, as we discussed in every one of your episodes, when they don't want to, the outlying approvals are gone, right? Those outlying approvals are gone. But when you're a fundable borrower, when you're at the bullseye, they're going to give you money and money and money and money, because every calculation they have, every algorithm they have says this person is going to pay it back. If I'm going to bet on on a dark horse, it's going to be the bullseye borrower. That's what we've been teaching everybody for years. But the point is now our people are killing it. We're literally over twice what our normal non-COVID fundings are for clients. And that's really good. Anyway, 2.5, 3 million. And now we're at 5 in 2 months. On this trajectory, we're going to hit 7 to 8 million in this quarter. That'll be a best quarter ever for fundings. And these are business lines of credit, business credit cards, business loans, right? The mortgages, they're not the refis, the actual purchases. So, so we're screaming. COVID's been good to us because we have the answers of people they're fighting us when they find somebody. They have a $20,000 line. They got a $10,000 limit. I mean, $20,000 limit. They got a $10,000 balance, and then all of a sudden it's dropped to $10,500 is their limit. Their utilization goes up. Their score plummets. Their fundability, and now you're in the toxic spiral where you cannot get more money because your utilization is so high, and the lenders bring it on themselves. So we even have strategies and scripts where we teach our clients how to pre a lowering of a limit. We teach our people how to negotiate what will serve the lender to protect the limit. And so far, we've seen a substantial improvement in the number of people who are getting denials. Now, fundable borrowers are not getting any of their limits done. That we've proven that 24-month look-back period has proven that these guys are legitimate borrowers and they're safe borrowers, and they'll continue to get limit increases. But I'm telling you, so it's a radical storm, right? An apocalyptic storm.
When you look at a couple of things too, because the banks have technically had a 6-month window to see who's on the naughty or on the nice list, right?
That's a great way to say it. Yeah, you know, and that's one of the big coaching pieces that we've been doing. We had a survive, thrive, or recover kind of web class, and we put that together. I mean, you know how much stuff I have in my head. Brad and I sat down and we literally built it's an 8-hour course where we were able to create this, where I just how to protect, and then how to thrive, how to talk to your lenders. And we had hundreds of people on because we posted it on Facebook Live saying, as soon as this thing is done, we're taking it down, bundling it up, and then we give it to our masterminders and clients. But we had hundreds of people watching because they're like, where did this information come from? So as I told you before we started broadcasting, is how just getting this out in front of people, because there are actionable tips you can do to stop the madness and protect your limits, protect your fundability, so that you continue to be fundable even right now.
So I love that. And here's another thing we'll throw in there and get people's mind twisted, because when you have what we've seen across the board too, is if you're in the commercial space, commercial lenders, I mean, we said banks have financed 53% of the distressed commercial stuff. Rent rates are down, vacancy factors are down. When you look at how commercial property is valuated, when you have reduced rents, And reduced values, that means your cap rates drop, right? And banks, when they finance, traditional banks don't want to finance higher really than 69% LTV because that gives them that cushion, right? Okay. You know where I'm going with this. But when you have values drop and you have rents drop, that means your value drops. That means the LTV that the banks are into doesn't reduce, it goes up.
Yes.
So now they're sitting at 75 or 80% or 85% LTV.
Which they don't want to be in just because that's way past their risk thresholds.
So you may have performing borrowers that are performing defaults because the bank's going to go back to them and say, like little Oliver Twist, can I have some more down payment, sir? Please, can I have some more? Can I have 5 or 10% of your cash to write down the loan, please, sir? And most borrowers and let's face it, most of the property owners aren't running reserves of 10 to 20%.
Right.
That leads to an opportunity. And I'm just saying this, if you're going out getting lines of credit or lines from banks on your commercial side, that's a great opportunity because a lot of times the banks will finance this commercial property if you're going to buy the debt. They don't want to lose that $1 million balance or the $250,000 balance. They're often willing to carry that paper if you're going to take over the property and do something with it.
So this is a commercial owner carryback.
Basically, yeah. The banks, if it's $1 million plus balance, a lot of times, if you've got the team and you're buying the note and the bar's blocked, we'll carry the paper for you as long as you bring some down payment or you're at a good LTV.
Right. But still, they're saying, we will. I don't even know if I have that is a strategy all by itself for use of funds, right? Clients come to me all the time. For the longest time, Scott, and you'll appreciate this, but for the longest time, I'm literally talking 2 or 3 years ago, I presumed the people would know what to do with their $300, $400, $500, $1,000, or $1 million in credit lines, business loans that we get them, right? I just presumed that they would know what to do with them. But some of the we had a client tech training once a month, right? The whole tech training, and I give it to my advisor team. What are the consistent questions that come up for being able to that clients want to know, right? Merrill, what can we? And like the most consistent question, I think it was in June, was what do we do with all this money? Because some of them are looking at that they were doing wholesaling and moving to fix and flipping, but flipping, when you have $600,000 in a Dallas marketplace, you're like, well, is that the best use? I'm going to have to do 70 properties to use all of that money. So they're starting to look for other wealth strategies. And I'm like, do I have to teach you not just how to get the money, but now what to do with it? I mean, it was like the first time in years I'm sharing with my clients other possibilities for use of funds. Because
I'll show you a strategy too. It's kind of a funny thing. This goes back to 2004, back when one of my first days in the note business, and my mentor had a couple students, a couple guys that were all pretty wealthy. They had roughly, 3 guys all had roughly about $6 million on deposit at a bank. So they all took their $6 million each and went to a bank and got a double line of credit. Instead of $18 million, they got a $36 million line of credit on $18 million deposits.
And that's a real thing, especially 2004.
And they went out and bought a portfolio of debt at 25 cents on the dollar.
Talk about multiples.
Oh, yeah, exactly. You get exponential in that. But that's the thing is, if you look at and leverage it right, if you got 200 grand as a line of credit, you could take that and put as 20 down payments of 10 grand, and then now you're in 20 properties. Or you could buy half of Cleveland.
Yeah, right.
There's a variety of things you can do, but that's the thing is you got to build it right. You've got to put the foundation in place. You got to know what you can and can't do. You got to stay at that level.
You got to know what you're doing. Yeah. I was talking to my office every week. My clients, we meet on office hours, right? It's where you meet with Professor Fundable, and we sit down and the clients, we just shoot the breeze, right? Well, one guy, and I've been doing this for a minute, but this was the first time a client had actually come to me with this. He goes, "Hey, so what I'm wondering is, can I use a credit line to buy insurance premium on a universal life that then I at a 10x factor and then borrow it for 1%. I'm like, shh, don't let the word out. But you don't want to use a credit line because they don't want to carry a balance that long. But that's what business loans are for. And yes, if you spend cold hard cash at 3.5% right now, cold hard cash, and buy premium on some of these insurance products, and then they have a 10x factor. So now you got $100 grand. So now you're sitting on million in or 10 million, I think is what it was in a insurance policy that you then get to borrow back. I was like, that's leveraging the leverage of the leverager.
That's an infinite to the infinite to the infinite banking, right?
Right. And so he was like, no way. And I'm like, so we'll talk about that in advanced strategies class. I haven't even put together offshore, all this offshore stuff, all the advanced strategies.
Might need to bring George Antone on here as well too to talk about all this stuff because he loves all that stuff and he can.
No, he's better at this stuff than I am, and I can make my way. This guy's like Michelangelo when it comes to the art of hacking finance. Right? Me, I'll get you money. Use that money to implement his stuff. Now we got the partnership from heaven. So,
well, and here's the thing about building your lines of credit and having that capital business. You have the opportunities available for you, whereas a lot of people don't have the opportunities out there. And here's the thing too: when you look at when you can leverage that money or leverage it across the board, like one of the things that we've tracked, Merrill, is how many people have IRAs across the country in the bigger markets. Okay,
right,
and from all the investing we've done, we always said, investors average somewhere around 100 grand. But what we found consistently in just about every major city out there, if you take like Salt Lake City, where you're at, had like 26,000 people that have an IRA account. Okay. 26,000, 2/3 of almost every city, the borrowers have at least 150 grand or more. And it's literally 2/3, almost exact down to the decimal across. They have more than 150 grand in an IRA account. And that's some stuff that you can leverage or leveraging other people's money.
Yeah.
That money's making roughly 0% because it's sitting in an account, not making anything, or less than 4%, right?
Yeah, absolutely.
Using your line of credit to find some great deals and leverage it by getting refinanced out with longer term money. Somebody looking for, put their money to work.
Their flip money. Absolutely, man.
So.
And something's coming. FICO's pulling out their recession prep tools again. They did that in 2019. COVID hit. It was the unlikely source, but we have too many cross indicators, right? There's just skyrocketing prices at the exact same time, even though it's full dock, but too much is going on. And by the way, here's a quick announcement. The very first fintech has been authorized by the Office of the Comptroller to be a federally chartered bank, the first fintech ever. So these guys are badasses at automatic underwriting. They're using all of the algorithmic tools, right? And now they're a chartered bank. So they're going to be coming in easily at a tier 2 or tier 3, which makes them a favorable instrument to use for clients, and more people are going to follow suit. The future of banking is going to be radically different than what it looks like today. But yet branches, this was one of the articles that I had done some research on, that same Gen Z, Gen X, they don't like fintechs. They're suspicious of them, so they like the big banks, but they hate branches, so it's all electronic. All their deposits are electronic, all of their withdrawals, all of their transfers, everything is electronic. So B of A, Wells Fargo, huge with the Gen Z. Now that makes a fundability market for me, because the top 4 banks are spectacular, right? Especially if you're a bullseye borrower and you're in the mood, and they're in the mood to lend to you to make up for capital for shortfalls in other areas of their portfolio. So I'm telling you, dude, we live in some amazing times.
You never think, another thing came out just the other day, we may be running out of time here, but is how there is a record amount of savings account being deposited right now that we haven't seen in 30 years, as people are putting money into savings.
Swirling as much as they can.
Yep, because of that. And you know what the banks are doing with it? They're leveraging that out in higher interest rate credit cards, loans, and lending on other things where they're giving you 0.1. And if they're making 1%, that's not a 0.9%. That's it's a 900% return.
That's a 900% return. We have a whole section in the boot camp. By the way, to all the listeners, go to getfundablebootcamp.com to see when our next boot camp is, because I don't know when this podcast is coming out. Get Fundable Boot Camp. Read the reviews. Just read the reviews. I'm even blown away. Some have drawn me to tell. I get all misty-eyed going, that's what you got from this? That's awesome. I'm so happy that's what you got. I mean, they're brilliant. So read those. But the reason why I bring it up is that there's a section in the boot camp where we actually talk about the bank rating system. They call it bank rating, but it's technically depositor rating, and however much money you have in there in factors of 1, 2, 4, and 7. And then you add a 0 for those. For 20,000, 40,000, 70,000, all those numbers matter, and you become more valuable as a depositor the second you have those in your accounts. So if they're going to leverage the hell out of those savings accounts.
Yes, they are, sir. Well, I know that you've got to run here soon, but
yeah. Well, here's a freebie for your listeners. There is, based on banking, and check me with this, because this was true the last time I checked, but I haven't looked at the code or the banking code recently. But it has, for all of my life, it has been true that funds that are in checking accounts are more actionable for lenders than funds that are in savings account. They're more meaningful because they have different right. They can use the funds in the overnight to trading differently than savings. Savings have an FDIC pushback on it. So if I want you guys to save, but what I want you to do is I want you to open up another checking account and put your savings into the checking account, not a savings account. You will become a more valuable borrower for that one move all by itself, because the lender can do it. Your money's still safe. It's still safe. It's just that you become more valuable as a borrower, because that money in that bank account is more actionable than the savings account. So if I could just get to every one of those savings people and say, just open up a new checking, cha-ching. So there you go. Brought to you live by Scott Carson and Company.
Good stuff as always, Merrill. Well, hey, you guys, check it out. Merrill goes through a ton of great information. This is just a drop in the bucket of what you'd learn at his next Get Fundable Boot Camp. GetFundableBootCamp.com. Well worth it. 2 best days that you'll spend online, live, learning from the master and maestro of credit right here. Have you gotten the lab coat yet, Professor Fundable?
I do. Grab the lab coat. I'm gonna put it on. And Sky killed it. She got me the pens and the Professor Fundable.
Very nice. There we go.
So there is the Professor Fundable. Oh, wrong side. Professor Fundable lab coat, and I actually put it on now in certain sections when I'm really geeking out. There's my pocket protector.
There you go.
So I actually geek out on a couple of sections in the boot camp, as you know, and so I put this on, and so far people have loved it. And I love geeking out, so there you go.
There you go. Bill Nye the Science Guy, eat your heart out, buddy.
Right? So true, man. I love it. But hey, I'm the geek, so you don't have to. You just get to make money, and I'll put money in your pocket. So
I love it. There we go. An apple a day.
Yeah.
There you go, baby.
Yeah. You can send me an Apple Watch per day. An Apple Watch per day, or iPhone or whatever, and I'll take it from there.
There you go. Good stuff. All right, Merrill, you guys be safe out there. Thanks so much for coming on today.
Scott, man.
As always.
Awesome to see you again.
Yeah, see you later.
Later, man. Bye.
All right, guys, that's going to wrap it for this episode. Check it out. Like I said, go to getfundableBootcamp.com. It's well worth it. It's tickets as little as $97 out there. But like I said, tune in. Check out some of the most previous episodes that we've had Merrill on a monthly basis here in the podcast. Well worth it. I think one of the most valuable educational pieces that we have on the podcast and helping you really capitalize and take advantage of what's going on in the market out there so that you can go out and rock it so that we can see at the top. Be safe, everybody. Bye.